Today, we're going to be talking about yield curve reversion, not so much the inversion, but the reversion, and why it's important and whether it could be signifying that recession is upon us. And then we're going to have a look at the NASDAQ and see if, there's some semblance of a continuation of Friday's price action, which was quite bearish. And then we're going to have a look at Bollinger Bands on the opening range, whether they can work and whether you can, use them to create a better trading strategy on that 30-minute opening range of the day. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So something to perhaps terrify you with this morning, it's this reversion that's gone on. So you can see that this is the spread between the US 2-year bond yield and the US 10-year bond yield. And effectively what we're looking at here is throughout 2021, we've seen a big decline into negative territory in terms of the yield. Now what we're seeing is the 10-year yield actually, become greater again than the 2-year yield. So what that's indicating really is that there are issues with the interest rate yield curve effectively, and it's signifying that there are recessionary conditions coming up. But the thing is that people tend to look at this spread in terms of when it inverts, the curve inversion, as being the sign for recession, that recession's coming when we hit, say, here at 0%, it starts to show that, that's when we're going to get recession. But really, recession is shown when we start to get above 0% from the downside, so from that reversion. So it's inverted, it's gone below 0%. Now it's reverting, that is when we get the recession generally, and it tends to come within 12 to 20. I think it's 12 to 18 months actually, not so much 24. But this would go in line as well with the monetary policy time lags that can be expected, and in sort of more financially developed economies, those time lags start from about 25 months. So the real monetary policy effects aren't felt for 25 months until after the first hike, which is quite astounding, really, when you consider the, relative damage that's been done already. Or is it? Equities haven't really sold off that much. We're still in relatively healthy territory in the equity markets. They are, of course, selling off today, and we're going to speak about that a little bit more. But in general, the real economy is still doing quite well. I think there's definitely warning signs and things are going to turn over, but they haven't done just yet. And that's sort of where I'm going with this, is that these rate hikes that we've experienced, 15 of them already, haven't necessarily destroyed the US economy yet, which is where this idea backing the concept that, there are 25 months until the economy really feels these hikes. Yeah, I think in terms of where we're headed with this isn't a good sign, basically. It's not a good sign. The US 10-year yield's up at 5.05% at the moment as well, which, again, for borrowing costs and for the risk-free rate is quite substantial. And yes, it's just a nominal number, but it's very psychological as well for the market. So I think this is also why we're seeing equities, get offered over the last week or so. We're seeing the market think, okay, God, the 10-year yield is above 5% now. That's all of our models pretty much having to price in higher interest rates for longer. Not good for risk assets, right? And this is really what the market's going to be focusing on now. So I wouldn't be surprised if you hear an absolute load of articles and mentioning of this across CNBC, Bloomberg, etc. Normally when it hits CNBC, it's a little bit too late. Bloomberg, fine. But it tends to be that we're going to hear a lot of furore over this now. And that furore these days can really actually cause the market to panic a bit, especially when, certain funds are leveraged in treasuries and they're doing certain basis trades, which I believe the SEC actually wants to clamp down on. soon. So, or the Fed, I can't remember, Fed or SEC, I can't remember. But yeah, that's where we are now. It's troubling, the inversion here. The speed of it's been quite volatile as well. It's just literally been about a month now since we've had this really, really strong move. So middle of September, Friday, 22nd of September is where it started. And it doesn't seem to be letting up. Very briefly, want to mention equities price action at the moment. So this is NQ. This is Nasdaq E-mini futures. And when we start to see something occur on a Friday like this, where it's quite orderly and you see a certain pattern occurring. So this was overnight on Thursday into Friday. This was the open. So the open was at 2:30, obviously. And what happened was at 2:40-ish, we saw the market completely sell off. Now, when this happens, it tends to be that, there's something sort of going wrong there. It's too orderly, but it's very systematic. And I think that we'll see something similar today. We tend to see a continuation when price action looks like that. So I'm watching out for at 2:40 today, any kind of break higher and then a collapse. That would be the way that I would look at it, because effectively what you want to see happening is people getting sucked into the breakout trade higher. They're stuck in a mindset of, okay, things are, all going well still. Let's just keep doing what we're doing. There's a lot of momentum-based algos out there on the buy side, and I think they're heavily dominating the whole of markets at the moment, these momentum-based algos. They're so used to just buying all the time. And I think we're in the environment now where we can probably say that, being bearish has a better probabilistic outcome for now than being bullish over the long term, especially intraday. So we're even seeing the market sell off a tiny bit as we're doing this. It's just broken the lows of the Asia range. So this is something that I'd be watching out for today, is a break higher, see if we get any bulls sucked in, see what the flow looks like. If you've got a depth of market, then have a look. If you see just buy orders getting absorbed in the market not doing anything, it means that probably it's not going to hang about at higher prices for too much longer. And yeah, that would be my focus now. The macro backing isn't fantastic. This yield curve reversion is happening quite quickly. And, there's probably two outcomes if you don't want to, have a look at equities. It's probably looking at being a bit more bullish the dollar. Or, yeah, I guess, indeed, just outright selling equities. But, yeah, that is the way that I would look at the market for the front part of this week. Now, I don't particularly use Bollinger Bands myself, but I've got this idea from something that I saw on Twitter earlier. And effectively, it is a way to show whether volatility is about to expand or not. And when it comes to the opening range of the day, that tends to be when the volatility really kicks off. And the opening range is when US equity markets open. So for anyone in the UK, it's 2:30 p.m. And you tend to see, as I discussed in the original video, that overnight you get these sort of flat ranges in US equities indices. So you've got one here, that's from Friday. You've got another one here. Seeing a little uptick in volatility right now in the morning, but you can see that generally expands as we get closer to 2:30 p.m. Now, what you tend to notice is that at 2:30, for example, you might see upticks like this, which go right up past the volatility band, whilst the volatility band is contracting. Now, that would be that would be something that I believe was discussed on the bit that I saw in terms of indicating a slight reversion. So I think, volatility bands and Bollinger Bands are fantastic tools to use to note the extremes of moves, or just when volatility is about to expand. So I think the tighter the band gets, the more potential there is for you to then take a position. So I think that's really where we want to go with it. But with the macro backing, as I've discussed in this context, I think if we do start to see those volatility bands, tighten up as price is moving higher to the top of a range, it could be a good selling opportunity. It could be a good time to feel a bit bearish, because we always have to think of who's stuck in the market and who is, easiest to get wiped out and what is going to cause the most damage. Right now, I think it's to the longs. I think it's to the long side. So, later today, have a play around, have a look at it. Don't necessarily trade it if you don't feel comfortable, if it's not part of your strategy, or if you don't know what your adequate positioning size could be. But I would say that looking at something like a volatility band to deduce when the market might move and get that maximum risk to reward could be a good idea.